Hello and welcome to Internet Capital Markets, the weekly show where we explore how financial systems are being rebuilt on the web. Each week, we sit down with the builders, investors, and institutional leaders shaping this transformation from tokenized assets to decentralized finance, stablecoins, RWA, and everything in between. Today's show is brought to you by TrustBytes, Smart Treasury for Internet Capital Markets. Before we introduce our guest, I'd like to welcome my co-host and co-founder, Jonas, as we are builders together, and he will introduce our guest today. Hi, Jonas.
Hey, GM. Happy New Year, everyone. Welcome to 2026.
Yeah, Happy New Year.
We finally also continue with our show here. And yeah, we start with like a phenomenal guest today. So kicking off the new year. And I'm really excited that we have Nadine WILKE on the show today. Welcome, Nadine.
Hi.
Welcome.
Hi. She
Great
is
to be here.
Yeah, welcome. It's our pleasure. And she's the co-founder and CGO of PARTICULA, the prime rating provider for digital assets. And in fact, we have a mutual history. So PARTICULA was also born in the German blockchain incubator, BFG, Blockchain Founders Group. And I think you've been like the batch before us. So we have been in the batch 2023, 2024. And yeah, you have basically like a wild ride behind you, especially last year. I think that was like a very wild ride with like a massive funding round for PARTICULA. Then you also entered like the US market. So maybe you can start with introducing yourself and telling us a little bit more how PARTICULA came to life.
Thank you so much for having me. Yes, so you're actually right. We were at the batch before you, and this is I think where I started. So I'm one of the co-founders and CTO, as you mentioned. I'm basically heading everything around growth at PARTICULA and go-to-market. And we started in 2022 and officially founded the German entity in January 2023. And when I look back to how markets was back then, especially when you look at tokenized assets, it was so different. So everybody was constantly telling us we are too early. What we are doing is great, but it's too early. And we already had the conviction back then that it's actually not too early. It's actually the right time to get active, because when a market is growing and establishing. And I mean, we will talk a lot about also standardization today here. These standards and benchmarks need to form, and they only form when, of course, things negatively and positively happen in the market, and market participants are learning about that. You have regulatory developments which are sometimes in favor, sometimes not for innovations, and I think especially when it comes to risk and risk assessments and the go-to-market of someone like us, and you can understand us basically like risk rating provider for tokenized assets. It's very important also to grow with the market and to learn from the market, because we don't have so many historical data like you have when you're a rating provider in the traditional space. You can look into a lot of history of data, but often these issuances are so new, the structures are maybe very experimental. Then you have sometimes different tech stacks, different jurisdictions, and everything is moving, so to say. And I think this is a reason why you have to be right there in the beginning, learn and iterate, constantly improve, and grow with the market.
I think you touched on many points already. Like we heard about like risk assessment, we heard about like digital assets, we heard about crypto. But maybe to draw the line here and make it a little bit more clear for the audience, like what people are doing exactly today. Is it like about like rating like the crypto assets like Bitcoin or Ethereum, or is it more like in the traditional financial world where we have like all these rating agencies like Moody's and Standard & Poor's and so on, which are like basically rating like any kind of like financial asset. Maybe you can give us a little bit more insight here.
Yes, sure. So maybe to also explain it first, the difference between us and more the traditional players like a Moody's or an S&P. And maybe one example asset class, let's take a bond or a fund. So in 2022, we already recognize that when you tokenize an asset, depending out of what jurisdiction, what tech stack you're using, you're simply changing our major product features. So it's not necessarily the same underlying asset. And we figured it's great when we have a triple A underlying rated bond, but it means nothing when it gives you no ownership rights, for instance, to the underlying. And in the end, the investor is investing in the token, not often directly into the underlying. And we figured that you need to have a more holistic assessment approach of these type of assets. And that's why we said very early on, we want to specialize on these so-called asset-backed tokens. So we have also, and you can look it up also on our website, it's called PDEX. It's our taxonomy, how we classify digital assets. And of course, there's, when we come back to standardization, a lot of different understandings what a digital asset is. But on the, let's say on the highest level, we distinguish digital asset between asset-backed and non-asset-backed, right? And then it goes down the pyramid to, you know, we have payment tokens, you have on the non-asset backed, you have, for instance, cryptocurrencies like Bitcoin, Ethereum. On the asset backed side, you have sometimes I call it slang words, RWAs. Of course, we don't like so much to use this word, but let's say you have traditional financial assets who are backing the token, but also more alternative assets, like, you know, real estate and so on. But I think the most common asset class which gets tokenized are bonds and funds. It's also the one which, of course, institutional allocators are more interested in the beginning. And it's also sometimes a more straightforward one to tokenize. And again, we said you needed to have a different approach. You need to start on token level by assessing the risk. Credit quality or credit risk in some sort is just one risk pillar. There are multiple ones when you assess this technology or this token, and this is what, you know, makes us different and our approach different.
Yeah, that's super interesting, and we will dig into that in the following minutes a little bit more. So now we are kind of in the move from the institutional capital markets to internet capital markets, and there are a few things that are underlying to this. So, for example, those internet capital markets assume open access to assets, but actually capital only flows where risk is really understood. And let's talk a little bit about why risk assessment is the missing layer in on-chain finance.
I think when you have, or when you create a new market, you always have, of course, different layers who have to come in place. I would never say you know, only need this layer or this layer is the only one missing, because I think we still have to do a lot of work when it comes to, you know, being actually able to have the volume of capital markets in this new world. I don't think we are there yet in terms of infrastructure wise. But of course, risk is a very important parameter, especially when you look at institutions who are, of course, they have compliance, they have regulatory restrictions, and they also, of course, have reputation they don't want to lose. And I think that's why you have to set some sort of benchmark, so they get comfortable at least, right? And I think risk, of course, is you always need to understand risk, because otherwise, how can you make, on the one hand side, decision making, but also how can you, you know, not only protect yourself, but maybe also your traditional clients or whatsoever. So I think this, and that's why people said we are early in 2022, because they were like, yeah, well, why should you focus on risk? We are focusing on what to tokenize and what is the best way to bring the data on chain. So it was more about this, and you know, it was less risk. And they're like, yeah, risk is just coming in when, you know, you actually have the market in there and you actually have money flowing and so on and so forth. And it's some sort of true. But also, I have to admit, of course, ratings really are really useful when you have secondary markets, right? And more volume on that side too. then of course you can create new use cases with ratings. You can use it as a measurement, as a metrics to build new products, or you can do portfolio rebalancing and so on and so forth. So I think it's a puzzle piece, and now we are here.
Yeah, definitely. And good that you started early, because now you can kind of shape it. So to me also, in short, like it's you mentioned trust. We need to have trusted risk signals. That's what you're building. And you have part of that open access exists, but without those trust risk signals, it cannot really scale. So now Particular actually standardizes the ratings from AAA to D for digital assets. And why is it or why is risk standardization so critical for scaling from your perspective?
Yeah, I think also it's we have to be careful with rating standardization, because first of all, I don't think there should be a framework for all types of digital assets, because when you compare crypto assets with tokenized assets, it's just different. So you need to have different frameworks, right? And also I think and this is also really important, I don't think that there should be only one risk rating provider worldwide doing that, because in the end you need different methodologies, maybe even also different approaches sometimes, to really have a holistic picture. And that's why I'm also happy when competitors are also doing some stuff, even though it's maybe contradictory. But I think for ratings it's important to have multiple views on things, and of course where we need to standardize, maybe also from a particular perspective, it's more when it comes to data and practices. Because of course, and this was 2022 a huge pain, when there is no data standardization, then in the end we needed to do that when we started Particular. So we needed to think about, okay, what should be the data sets on the issuer, on the token and underlying asset level? How can we maybe standardize that across different asset class? Because when you look at it, tokenized real estate, it's fundamentally different to a tokenized maybe bond or whatsoever. And then you need different data schemes for the underlying, because you have different metrics. And so standardization can be in digital assets very complex, because you have so many different asset classes, different also blockchain ecosystems who have different tech stack in terms of like smart contracts. So Ethereum is different to Solana, and therefore also the product structure can be different. And then you have jurisdictional differences, right? And I think standardization is on all levels important to make it even possible to issue in one country, and having maybe it listed cross-border on different exchanges when you want to go the more traditional way. But then you have the DeFi side where you're like, okay, I also want to structure my assets so it can be used for DeFi use cases too. And this is sometimes one or other way. I also see now the first ones where they're mirroring basically the tokenized product, so they can use it for DeFi use cases in vaults, for instance, or as collateral whatsoever. And I think that's why we should talk about more the data standardization. Interoperability, of course, is a big topic there. And standardizing risk rating, it's more about benchmarks, and also it's more about risk mitigation procedures, like how do issuers mitigate certain risk. And I feel like standardization comes sometimes naturally, and when we are seeing different issuances, and then there's some issuers telling us, oh, we can only structure it in that way, and we have to basically live with a certain risk, then we, for instance, can say like, hey, but in another product structure we have seen they implemented XYZ, for instance, in the smart contract, and this is how they mitigated XYZ. And that way we create standardization, I think, which is helpful for the overall market. And it's just naturally, and it comes over time.
And also creates kind of a common language, so that you can really do comparison benchmarks and not do apples and oranges comparisons.
Yeah, and it's for the due diligence to go to scaling too, right? So if you want to have or onboard institutional adoption and also allocation, it's very hard to do due diligence on product structures who are so different. So they always have to put so much effort in that until they make a decision, or maybe not a decision, because it's just too risky for them, or they are not able to assess the risk, so to say, for themselves.
Mhm.
Yeah, we already digged a little bit into like the fundamental differences here between like rating in traditional finance and now rating of digital assets. Another fundamental difference is that basically traditional markets or public markets are like just open from 9 to 5, Monday to Friday, right? And digital assets basically trade 24/7 and in real time. And when we are looking at like these differences between like TradFi and like let's call them on-chain assets, where do you see like risks only on the blockchain side, where basically traditional or like assets in the traditional markets are not affected basically? So where do you see like additional risk, if you will, for digital assets?
Yes, so maybe also to before I answer the additional risks, I think when you look at how assessment practices are going in the traditional world compared like what we are doing sometimes, and what the additional risks are, so to say, which we are looking at, and I already mentioned some of them. When you look in the traditional market, usually what you do, you have way better data quality sometimes because they have reporting duties. They are forced by regulation, for instance. They have compliance procedures. They have slow periodic statements they are publishing, their financial statements they can offer, and so on. And you often only calculate the probability of default, right? And I think and I mentioned that in the beginning too, right? When you have a tokenized assets, we are talking about a technical product which is programmable, which can sometimes even change overnight. And I think here comes also the additional risks, right? There are some sort of similarities when it comes to the issuer and the underlying asset level, where I feel like there are some, similar metrics, of course, but on the infrastructure level, the technology level, it is very different. And I heard many times in the past that especially traditional financial professionals are telling others, yeah, there are no different risks. It's just a different infrastructure. It's the same asset. It doesn't matter if the bond is the bond or it's launched on Ethereum, for instance. And this is what they sometimes don't understand, how much the technical implementation can influence, for instance, compliance procedures or the code itself, right? When the code has issues, then of course you can hack the smart contract, you can manipulate the data or the pricing. And there we're talking about the oracle risk, we are talking about smart contract risk, we are talking about also risk which maybe is not too visible at the same time. So for instance, when you're listing a token here in Europe and you want to make sure this token is always compliant with MiCA, for instance, and you have to make sure that, for instance, the token issuer is not changing features in the smart contract which are required regulatory, so the token is not compliant anymore, and you maybe don't see it because you're not monitoring it, for instance. So I think these are so different risks, or terms and conditions get changed overnight and then you have different ownership rights or whatsoever. I have also seen that in the past. I think these are additional risks. And I think what is also very different and interesting, sometimes, especially I see it from traditional risk providers, they think they rate one token and it's for all blockchain ecosystems, so to say, the same rating. But when we evaluate that and see the different blockchain ecosystems and how it's affects the tech stack and the overall quality of the issuance, that actually you cannot say this token and this rating is for all the blockchain ecosystems. So for instance, a token is launched on 6 different blockchain ecosystems. It theoretically should get a rating for each token launched on each chain. And I think this is also sometimes which is very unusual in the real world, so to say, and which makes our job often very hard too. Yeah. But maybe you have also 2 cents about that. Would be happy to hear your what you see, what risk is maybe different in this new world.
No, definitely like the programmability. So if we are like looking at, you mentioned it, like smart contracts, and we just look at like the hack statistics of last year, I think like more than $3 billion got stolen by smart contracts. And I doubt that like any kind of like financial institutions that is like fully regulated can accept that, right? Especially like if we are talking about like clients funds that are basically invested on behalf of financial institutions. This is like an unacceptable risk. So definitely the additional layer of like code that is like managing like real assets is like, in my opinion, like what is like truly new to any kind of financial asset compared like to traditional markets here.
Yeah, I agree. I think that there's also extended to that the governance execution risk, that because everything is directly executed on chain. So you need to look at the governance decisions, how they are being done, and this brings risks from a legal perspective as well.
Definitely. I think, I mean, there are so many. Also, it's a settlement. It's also liquidity risk, reorg risk. It's yeah, and I think that's what we still need to figure out, right? When things happen, I think a few months ago we also saw it, especially on the vault side, when there's like a massive liquidity collapse happening. It's everything is going so fast, and then when you don't have risk management procedures in place who are maybe then blocking something or protecting the assets, then it just get liquidated. Everybody's afraid, and then you have a run. And I think this is also very very unique for the DeFi space, how quickly things can go down.
Completely agree here. So you already touched on a few things like liquidity risk here. And do you see Particular's ratings actually influencing liquidity and how collateral is being accepted and investment decisions are made in DeFi or those tokenized, even if you don't like the word, RWA markets? And also curious for the audience to understand which assets you already support today.
Yeah. So there are different business cases, right? You can do with risk ratings. And maybe one first example when it comes to allocation, decision making. There are some allocators we're collaborating with. And for instance, what I quite find interesting, what they shared with us, is on the one hand side that how they see the ratings for themselves. And I think also maybe one step back, sometimes people confuse ratings also, especially when they maybe don't have a financial background and so on. They think ratings determine what is risk-free and what is risky, so to say. And then you make the decision to sort like, oh, I don't want to take the risk, so you know what I mean? So it's very simple for some people, but it's actually more about like a filter system. So in the end, everybody needs to do their own due diligence, and even hedge funds and the traditional space, they're not only relying on external credit ratings, they have their own credit teams internally who are calculating the risks by themselves. So usually they use it for some sort of benchmarking and then filtering, and then in the end they do their own due diligence and then they decide, for instance. And I think in such a new space, and I also mentioned before that it's very difficult to do due diligence, right? And there's not much you can rely on. So of course the early allocators in the space, they are saying, well, we don't necessarily always need a rating to make a decision if we want to invest or not. But of course it determines how high the investment amount is. So of course, if they have the rating and the transparency and so on, they are more willing to pay or to invest, I don't know, way more than they would without a rating. And I think this is quite interesting. So it's more about not if, but how high, how much risk then I want to take. And this and this basically then decides like how high the amount of investment would be. So I think this is interesting. Another business case which we did in the past was a stablecoin issuer who wanted to back their stablecoins of a different basket of money market funds, but not direct money market funds, tokenized money market funds. So there you see we have even two token layers. You have the stablecoin, you have the different tokenized versions of the money market funds, and then you have the underlying money market fund. So different layers. And then, of course, it's very important to see what is the ownership rights, and in the end, when you invest in the stablecoin. And also, and for them, it was important to have procedure in place how to decide which tokenized money market fund we want to back our token with, because when something happens, of course, we have reputational issues here, and also we want to have something in place so that we can, something happens or whatsoever, and then they are exchanging one and put another thing in the basket then. And for that, we created also like a rule-based selection framework that they can use for themselves to make the selection based on set rules, basically. Of course, then the ratings are also or can be used for optimization, or we also have monitoring services. So it's also very important to monitor, of course, everything and not have a static assessment. So these are the use cases. And then the newest one, big one, it's the KEEL program, which we announced together with Kinetica and the Solana Foundation in December. It's also a big allocation program to allocate into different digital assets, not only tokenized products, also other DeFi strategies. And they are starting now with the first program. It's a total of 2.5 billion, but they're starting now with 500 million. And there, for instance, we created the whole RFP process. So basically you can see like a questionnaire on all levels, which the issuers who want to apply have to deliver. And this RFP process, of course, it's very intense, and it goes into every corner you can imagine, but they rely on us in regards to like, okay, you guys have seen everything we can imagine. You have seen all product structures, different asset classes, so you know how these assets are structured and what is common. There, of course, we can bring in our expertise very well.
Yeah, Nadine, this is super interesting. We are nearly at time, but we still want to do one thing. So let's switch gears a little bit and go to our quickfire session. And I will ask you a bunch of questions. You have one word each to answer. Are you ready?
Okay, I hope.
So let's go. The most misunderstood risk in crypto today?
Liquidity.
The most overrated metric investors focus on?
TVL.
One risk TradFi underestimates in Web3?
Speed.
Now the other way around. One risk Web3 underestimates from TradFi?
Regulation.
Good one. One word to describe the future of tokenized finance?
Bright. Sure.
Something institutions require before they seriously would allocate capital on chain?
Security.
Okay, now one sentence to answer. If internet capital markets scale to trillions, what role does Particular play behind the scenes?
Oh, as the bridge.
Nice. Okay, last but not least, how do people find you and who should we talk to next?
So you can find me on LinkedIn. I'm very active there. I have Nadine WILKE, very easily to find. Our website is particular.io for more information, and also if you want to reach some rating reports. And who you should talk next. I'm not sure if you have talked before to, for instance, Kamui. It's an allocator, and they are sitting in the Emirates, and they are allocating for a long time in digital assets and now also tokenized assets, and could be interesting to get their perspective on how they decide and in what to allocate, and maybe how they do their risk management internally.
Yeah, good one. All right. Thank you so much, Nadine. That wraps up this week's episode of Internet Capital Markets. A huge thank you to Nadine for joining us and sharing her insights about risk ratings and everything around that. If you enjoyed today's discussion, make sure to subscribe, rate, and share the show. It helps us to bring more conversations with the people sharing the future of on-chain finance. This is Internet Capital Markets. Please join us next week. Until then, stay curious, stay connected, and keep building the future of finance. Bye-bye.
Thank you for having me. Bye.